concerned, that they're trying to negate by saying whether it is voluntarily or involuntarily, you're going to call it as a transfer. And I'm going to refer to a number of minor rights also, and these are also going to be regarded as transfer. Look at a situation of a place where they say that they're looking at these type of rights concerned, whether they're doing it voluntarily or involuntarily, I'm going to call it as a transfer. What type of rights are talking about? To go back to 247 subclause 6, for example. Go to 247(6), which says any transaction, whether by way of becoming a shareholder or a member of a cooperative society or a company, or any transaction whatsoever, which has the effect of enabling the enjoyment of an immovable property, shall be a transfer. So any right whatsoever, what should it achieve? It should achieve the transferring of the or the enabling of the enjoyment of an immovable property. How do you achieve that? You could achieve that by whatever mechanism you want. You could be a shareholder of a company also, I'm not concerned. If you are a shareholder of a company, and by virtue of a transfer of shares itself, you are transferring the enjoyment of an immovable property or enabling the enjoyment of an immovable property, I will call it as a transfer for 247 subclause 6. Take a case of a company that has land in this country. They're saying if you are a shareholder of the company, you are transferring shares, as a result of which you are enabling the enjoyment of an immovable property going to somebody else, then you have to disregard the entity itself, disregard the company itself, disregard the company and say that you have transferred the immovable property. That's the fiction they're trying to create. Therefore, when you're transferring shares, you got to ensure that you're not transferring shares, you have to assume that you're transferring land by itself. One. Two, in that process therefore, to get to this conclusion, you have to ignore the intervening company. Now we are laying down a significant proposition to say that although a company is a legal entity for so many other purposes, all through the Act, for the purpose of transfer, I am going to ignore this company because by virtue of being a shareholder or a member of a cooperative society, if you are enabling the transfer of an immovable property being given to somebody else, then that transaction shall be regarded as a transfer of the immovable property, not a transfer of shares. So I am therefore ignoring. This is a very dangerous statement to make now. I am ignoring the intervening entity is a very dangerous statement to make. Under what circumstances you ignore? Under what circumstances you ignore? Supreme Court did make a mention that when there is a 51% shareholding, when there is a shareholding of a foreign company and the value of the foreign company is derived by underlying Indian assets and that contribution of Indian assets is more than 51%, then the share is said to be situated in this country. That's the mandate. That's the mandate that is carried through a 911 explanation 5 even today. Rightly or wrongly, that mandate is not happening in 247, is not happening in 214. That mandate is not carried out through. Therefore, the question that going to be logically asked is, what is the extent of transfer? What is the extent of control? What is the extent of contribution I need to demonstrate before I get caught within 247 explanation 2 or buried with 214 explanation? So technically, if a person is a 10% shareholder in a company, 90% are held by somebody else, and there is an underlying immovable property in that company concerned. When you transfer 10% shares, are you going to make a statement, I am going to ignore the company, I am going to say there is a 10% transfer of the immovable property? We are all very confused, this is not the correct answer. This should not be the correct answer. It should be a situation where there should be a basic threshold of control being satisfied for me to say that there is a transfer of immovable property. Logically, therefore, 915 should have been read into or should have been incorporated into 247. They have not done that. They have not done that. As a result of it, therefore, the extent of control required is not very, very happily worded in 247. You will have, therefore, trouble. Somebody wants to say, an IT wants to say, look here, you are a company, you are a shareholder of that company, the company has immovable property, by transfer of these shares concerned, you have effectively transferred the immovable property, then you're going to have difficulty. And in what type of company they're going to have the difficulty also not spelled out. Suppose I'm a holder of Reliance shares, and I'm transferring Reliance shares. Does it mean that I have ignored the existence of Reliance? I do not say I have transferred all underlying immovable properties of Reliance. Where do you draw the line? Or which type of companies do you draw the line? Do you have to draw the line only in those companies which have an articles of association which say that these articles of association shareholding shall give the right of ownership of property? Are you going to limit to only those type of companies? Are you going to limit them or extend them to all type of companies? It's not clearly laid down in 247. Therefore, the difficulty. Somebody can tell you, Ruchir, I don't know what the law is. Law is telling me, or law is empowering me to ignore the company. This ignoring the company is becoming a very difficult issue for us. We ignore the company when you go up to section 79. We ignore the company when you go down in relation to 247. Take another simpler example. Let's not go into a complicated example. Mr. X is the owner of a property, owner of a building. X Company Limited is the owner of a building. X Company Limited is the owner of a building. It has a number of tenants in that building from which it is getting rent. X is transferring shares. As a result of transferring shares, what is it transferring? Is it transferring land? Obvious answer is yes. Is it transferring building? Obvious answer is yes. Is it now independently transferring also the tenants to the third party concerned? So are there two transfers now? Because law is saying rights associated with that share are also getting transferred. Rights associated with that share are also getting transferred. Therefore, two things are going to happen by virtue of this single act of mine. When I sell shares, one way of looking at things would be, I've transferred the land and buildings. That's fine. They're saying ignore the existence of a company. Fine. I'll ignore the existence. What I'm doing therefore? By limb 1 of 269 UAD, read with 247.6, I'm saying I'm transferring land and buildings. 269 UAF limb 2, read with 249.6 will tell me, not just the land you're transferring, not just the building you're transferring, you're also transferring all the rights. You're transferring all the rights. What is the right? The right to receive rent, right to have a tenant there in the property concerned. That also is being transferred. Now, am I transferring two assets? Am I transferring two assets? Am I transferring building individually? Am I transferring along with it separately the rights associated with that building, being a tenancy right? These are questions that could be asked. This could be troubling us tomorrow. The correct answer to me would be, if there are land or tangible assets per se, then you should exhaust the definition remaining with the tangible assets. You don't have to go to the rights associated with those assets concerned. That's because when you read 269 UAF, it's extremely important for us to understand what 269 UAF is telling us and what the board circular number 495 is telling us. Extremely important for us. 269 UAF tells us that in relation to a tangible immovable property, a transaction of sale, exchange or lease of more than 12 years shall be a transfer. Next it says, in relation to any other rights and immovable property, I shall have a transfer if it has the effect of enabling the enjoyment of immovable property, but that limb 2 says, I shall exclude for that limb 2 purposes sale, exchange or lease of more than 12 years, which are already covered within the ambit of sublimb 1 there. So sale, exchange of lease of tangible properties are covered separately, individually. Limb 2 of 269 UAF excludes this type of transaction. Although these transactions are not inbuilt into 247, the logical and correct way of reading things would be to make a bifurcation even for 247.5 and 247.6. The 247.6 deals only with rights in building, does not deal with land or building per se. And this is what is clarified by the Board Circular 495 when the law was brought into the statute to say that you are only relating to or dealing with rights in property other than land or buildings. The 247.6 should be read as having a limited understanding or a scope. Therefore, it's important for us to look at the contextual placing of these sections concerned. Therefore, looking at any transaction, this vivisection or bifurcation has to be very closely understood. One will normally go into case laws and try and find out what's happening. If you go into Ishikawajima's case, it says, I break the contracts into on-site performance, offshore performance. On-site performance, bifurcate the consideration, say that's happening outside the country, not deemed to occur in this country. Offshore performance, I'm going to say taxable in this country. So Supreme Court accepted the proposition that consideration needs to be bifurcated. Vodafone says, you can't bifurcate the consideration. The entire amount of consideration is referable to the transfer of shares, which transfer happened outside the country, as a result of which, therefore, you can't bifurcate the consideration. So therefore, are these two Supreme Court decisions laying down some sort of a proposition that is not in sync with each other? If you look into vested companies case, look into a number of cases, you will find that aspect of vivisection dealt with. The underlying philosophy that we need to appreciate, is the fact that where there are more than one asset involved, then bifurcate the consideration over various assets. Where only one asset is involved, having a number of rights that constitute the asset concerned, then don't bifurcate the consideration into various rights. Unless you are able to carve out that right independently and separately, say, this is an asset by itself. Take the case of a lease transaction, where I am carving out the right of use, the right of possession from an asset concerned and giving it out for a premium or for a goodwill. In that situation, yes, I am able to now demonstrate by my act that these are individual separate assets. These are rights in rem which I can enjoy against the world at large. Only at that point of time, make a bifurcation of consideration to various assets that are now independently existing. Otherwise, if a single right is being transferred with all the congeries thereunder, you don't bifurcate the consideration, you let the consideration remain one. Therefore, the understanding should be, find out what is the underlying or the subject matter of the transaction. Subject matter of transaction are separate assets, then bifurcate the consideration. The subject matter of transaction is single asset, they don't bother at all. In the course of the discussion, therefore, they were asking in relation to the joint development rights and the properties, what would happen when a person a developer is handing over the immovable property post-construction to the landlord. Would there be a chargeability of gift under 56(2)(10) was another question asked. So another question therefore in relation to transfer and the associated concepts. What does 56(2)(10) tell us? Or 56(2)(7)(2)(7)(a) that are earlier happening. 56(2)(10) is more omnibus, applicable to all assets as concerned, therefore we will discuss 56(2)(10) to say the receipt of any specified asset can give rise to a taxable event. Therefore, the question logically is, look here, this landowner at the end of the job is getting his building from the developer concerned, therefore there is a receipt. When there is a receipt, question to be asked is, at that point of time, did he pay any consideration? The answer is no, you're going to pay tax on this receipt of building at the time when the builder went to hand over completion certificate being obtained in relation to that property. Therefore the question is this the correct understanding of the law? Law definitely talks about a receipt of a building. But can this word receipt be understood dehorse the giver? Can it be understood dehorse the giver? If I am a person receiving it, should there be somebody who is giving it to me? No. Is the developer giving it to me today? That means, if the developer is giving to me today, is there a transfer happening by me to the developer today for the developer giving it to me all over again? What happened actually was, when the JDA was entered into, assuming for a moment the transaction was completed, transfer was over at that point of time, I had transferred 60% of land, typically, in exchange for 40% of building. Presuming the exchange rate was, I give 60% of land, I'll get back 40% of the building. It presupposes therefore, at the date I enter into a joint development agreement, there is giving up of land by me. And what am I getting in return? A right to get a superstructure tomorrow. That's a right available to me. That means I have a debt. I have a debt from the builder concerned. The debt is due to me. If that debt is due to me, if I am getting something today, that receipt today is not an independent receipt. It's a receipt in satisfaction of a pre-existing right that I have. If I am not receiving anything today, it's a question of the conversion of right to receive being fulfilled. That is conversion of right to receive into an actual tangible property. In my opinion, there is no second receipt of this property concerned, therefore should not be amenable to 56(2)(9) or 56(2)(10). Even otherwise, the law talks about what? Absence of consideration. I've had consideration dealt with. The entire amount of consideration was examined at the time the JD was entered into. Tax implications were attached. Question of therefore examining all over again the adequacy or inadequacy of consideration should not arise in that eventuality at all. The last of the conceptual understanding we will talk about is in relation to the fact whether the time of accrual of capital gains is an important aspect. Time of taxability of capital gains. We did make a reference to certain specific sections we're talking about receipt of consideration, receipt of additional compensation, conversion being the date of transfer. I am not for the time being concerning those specific special cases of transfer as dealt with by the statute. I am referring to a situation where In normal circumstances, a transaction of sale were to happen, a transaction of joint development were to take place, where I'm giving my land in exchange of a right to get a superstructure. When should transfer be said to have taken place? We'll all go to the case law and say, look here, case law tells you that there is a part performance, there is a GP executed, therefore 247.6 or 247 sublim 5 is satisfied, there is a transfer. You should go back to section 45, tells you, yeah, profits and gains arising from the transfer of a capital asset. There has to be a capital asset, that is satisfied. There has to be a transfer of the capital asset, that is satisfied. There has to be a profit and gains from that transfer, that has been satisfied. So these three are satisfied. But the most critical aspect of 45.1 is profits or gains arising from the transfer of a capital asset. The word used in 45 was, it has to arise, capital gains should arise. 92.1 tells you income from arising from an international transaction shall be subject to arm's length principle under chapter 10. The word arising is used here. Profits and gains arising from the transfer of a capital asset. So mere existence of a capital asset, mere transfer of a capital asset, some sort of a profits and gains capable of being computed, therefore profits and gains satisfied are not sufficient. The fourth limb of this entire conundrum is that the profits and gains should arise to the assessee concern. What do you mean by the word arise therefore? Because you go back to section 5, it tells you that taxability happens on accrual, arisal or receipt. Now receipt not happening in my case because receipt will happen much later when I get the building physically. Receipt will not happen at all. When I get the building physically, yes, there will be a receipt. Possibly I look at that eventuality there. You're not looking at that situation. You're looking at a situation or a stage earlier to that. The law tells you that there has to be an arisal of profits and gains. When does this arisal happen? Go back to Supreme Court in Sassoon and Company's case, 26 ITR 27. What do you mean by the word arisal? Supreme Court says, accrue and arise are two distinct concepts. Accrue means a right to receive, where the debtor-creditor relationship were to emerge between the parties concerned. I could sue him for the non-performance or the non-satisfaction of a debt, my situation concerned. So the moment or the point of time when I have a right to receive this money concerned, it's at that point of time that the term accrual is satisfied. Arisal is that situation when this right to receive gets crystallized into a situation where I am capable of recognizing that in my books of account. It should take some tangible form. I should be able to therefore have the certainty and the mathematical accuracy to that for me to be calling it as fit to be recognized in the books of accounts. Supreme Court therefore said, arisal is a stage post-approval where arisal were to transform itself into a tangible shape for you to be able to measure it very well, to be therefore recognizing that in the books of accounts. So arisal is a stage beyond approval. Although Supreme Court said, in the context of what we are discussing, that the managing agency's transfer in Sassoon Company's case, they said, we will for the time being not go into great distinction because our problem for this case will be solved if we were to comprise and compress accrual or arisal into one category and compare that with receipt, that's all. We are not going to go into further bifurcation. But they did make observations about the fact that there is a distinction between accrual and arisal. Arisal is a stage much beyond, where it assumes tangible shape or a form sufficient enough to be recognized in the books of accounts. Now, if that were to be the understanding of an arisal, in a joint development property, whenever to give my land away to somebody, what is the stage of arisal? When do I think I will be able to recognize something in my books of accounts as being concrete? The law can have so many features about deeming that they have inserted today. 50D is an insertion today. I am looking at a situation D horse 50D to say what will be the point of time when the profits and gains were to arise to an assessee. That point of time when it assumes tangible shape. When is the tangible shape? When the building were to be ready. When there will be some sort of an obligation upon the building to say I have completed my obligation, take this building and give you formally the title to the land. At that point of time, it assumes tangible shape or form, and at that point of time, I should be able to recognize that in the books of accounts. At that point of time, therefore, I should be able to say income were to arise to me from that transaction. And therefore, you have to wait for this eventuality to happen. Only then the condition of 45.1 will be satisfied. That's one part of the story. But interestingly, very interesting, it says, profits and gains arising from the transfer of a capital asset. So it will satisfy all these conditions. But then the taxability will go back to the year of transfer. So wait, that's a very interesting conundrum that we are getting about. Profits and gains arising from the transfer of a capital asset effected by the assessee shall be taxable in the year of transfer of the capital asset. That's the problem the law is creating. Law is creating, therefore, wait for the arisal, wait for it to assume tangible shape. Once it assumes tangible shape, you satisfy the main body of 45(1), but then go back to the year of transfer and tax it. That's the very clear reading of 45(1), very literal and logical reading of 45(1). This courts were not able to appreciate. They got confused to say, no, how do you go about this proposition? And therefore you find a huge amount of variables, a huge amount of confusion, lack of consistency in the tribunal decisions, various and across the High Court decisions. In fact, Karnataka High Court has had 4 or 5 decisions now, each trampling upon the other, not knowing where we are proceeding. Therefore, Sharma was telling me that decision is wrong, Sudhakar's decision is wrong, his wife's decision is different. I understand, appreciate all of that. The problem to me arose because nobody was able to put forth an argument that yes, it is an arisal that will be the completion even for 45. Possibly it will go back to 45(1) and year of transfer to be the year which the taxability should arise. But for you to go there, you have to satisfy the event of arisal. We didn't do, we didn't wait for that. We said transfer is over, therefore arisal also practically also over. That were the, in my opinion, not a correct understanding of the legal way in which the law has to be understood. Therefore you find different decisions of tribunal. Karnataka High Court is one, and the classic cases Hyderabad tribunal over a period of time. 2 classic cases of a number of decisions, nobody is following the other, nobody knows what's happening. Hyderabad tribunal, Radhika's case, number of decisions are there. Trampling upon each other, not knowing what they're doing, not even distinguishing the other, saying, I don't know what happened here, I'm giving my own law. And they gave a lot of confusion. Possibly because of this, they realized that there is some difficulty about the event of arising happening. I don't have to wait for the tangible shape to come about. I need to therefore crystallize the event right away. Therefore, they brought in 50 capital D to say, that I don't wait for the asset to come in. I don't wait for the arisal of event to happen. I don't wait for the principle of George Henderson's 60 ITR 622 to be satisfied. I don't wait for all the events concerned. I am now filling in that portion of arisal by saying, I don't wait for the asset to come in. I will only wait and say, is there a transfer that is happening? Is the transfer to happen? I don't know what will be the tangible shape of the asset to come in, but I am saying therefore, the value of the asset going itself is deemed to be the full value of asset that is going to come into the possession of the assessee, and you are liable to pay capital gains tax. And therefore, the difficulty about timing of arisal and going back to the year of transfer is possibly now taken care of with the insertion of 50 capital D. That's the way you need to go about to say 50D therefore saves the person concerned. So what happens therefore in the year of transfer? Nothing should happen. Originally, you have to wait for the year of arisal, go back to the year of transfer being taxed. Now they are saying, don't go to the entire circus. The year of transfer where to happen? Then I'll use 50D to say the fair market value of the property, the asset going out, shall itself be deemed to the full value consideration received by you, you'll able to pay capital gains tax. This raises a lot of difficulty otherwise to say, how am I to pay tax? How am I to pay tax on this aspect right today? There's going to be a lot of difficulty for me to pay tax on a value of the property where I'm not too sure also that the property will come back to me. When it will come back to me, I have no cash component. How am I to be saddled with a huge amount of tax outgo? That has sought to be addressed by 45(5) capital A today. Now I'm trying to introduce some new concept into 45(5) capital A, and we'll therefore spend some time for the request to say that what will happen now under 45(5)A for the groups concerned. Go back to the proposition that there is a transfer on the date of JDA. To me, that itself is a suspect proposition. But you're going ahead with that proposition. 53A of the Transfer of Property Act being satisfied, therefore JDAs are taxable, is a difficult proposition today. I'm repeating again that you have to understand that if I'm a landowner, I need to come within the part performance concept under limb 5 of 53A. I cannot go into limb 6 of 247, which talks about rights in relation to property, because law tells you rights in relation to property have to be ignored when I am the owner of the property itself. Tangible property being there, I don't have to go to some limb 6, I go to limb 5 only. Limb 5 will be satisfied only when there is a part performance of a contract under an agreement. Now, part performance with whom? By a person or with a person who is the transferee of the property. Who is the transferee of the property? Is the developer the transferee of a property? The developer is not a transferee of the property. Ultimate buyer shall be the transferee of the property. Developer is the person whom I have given a license, whom we have given an easement type of a situation to say that you enter my property, do the construction, and we'll have an arrangement of exchanging some portion of land in exchange for the superstructure, and I will find buyers concerned to whom we sell the property. Therefore, developer is the person who is using his skill and capital for the purpose of exploiting and making money. He is not a transferee of the property. Therefore, basically another threshold, 53 of the Transfer of Property Act should not be satisfied with what the developer is concerned. 1. 2. Is it a contract for sale or a contract of sale? Only contract of sale should be covered by 53A. An executory contract, where there are going to be obligations performed, cannot be a subject matter of 53A. 3. You can also say that the developer should be a person who is willing to perform his part of the contract. He is a person who is going to fulfill certain rights in his favor to translate or transform into ownership. He is willing to perform that part of the contract. Willingness is there, his ability to do is there, and he has also done some act in furtherance of those rights concerned. The contract also should have been registered. So if there is non-registration, or if there is some default, whatsoever of or by the person concerned, then you don't have the transaction satisfying 53 of the Transfer of Property Act, and therefore you are going to make a statement that I am not going to be complying with 53 of the Transfer of Property Act, therefore there is no transfer. 155 ITR, Govind and Gangasaran's case says there are 4 measures of taxation: person, event, rate, and the measure of the taxation. In a joint development of this nature, possibly the measure of taxation would have been satisfied, but for the condition or insertion of 50 capital T. Therefore, these were situations concerned that in relation to 53 of the Transfer of Property Act, there were adequate grounds to say that, hey, there is no event of transfer. That they are now saying, if you are able to get over that situation concerned, is one part of the story. We go ahead to the proposition that the entering of a joint development is tantamount to a transfer for the purpose of understanding 53A of the Transfer of Property Act, understanding 45(5)A, which has now been proposed to be inserted. I'll repeat again that there could be adequate answers, there could be adequate legal reasons for us to say that in a joint development contract, 53A of the Transfer of Property Act is not satisfied. Possible. For the time we will ignore that to understand as to what happens in the 45(5)A. Therefore, assuming for a moment that there is a transfer when a joint development is entered into, an agreement is entered into, then we go back to find out the contours of 45(5)A. It says that when there is a transfer of a capital asset, what type of capital asset? Land or buildings or both. Use words land or building or both. And by whom should it be a transfer? It should be a transfer of a capital asset by an individual or a Hindu undivided family. So only 2 entities are covered in 45(5)A, other entities are not covered. And there has to be a transfer of land or building or both. That means other type of interest in lands will not be covered in the 45(5)A. Only land or building or both. Important therefore to understand therefore, I made a reference to the term immovable property. The word immovable property is defined in the General Clauses Act 326 to say it includes land, things attached to land, also includes benefit to arise out of land. Therefore, some sort of interest in land also is covered. That's the definition of immovable property. We can't import that definition because rights may be an immovable property under General Clauses Act, but the law as defined now or proposed now talks about land or building, don't talk about interest in land or rights in land. Land or building or both, owned by an individual or a HUF. If a transfer has happened by virtue of a specified agreement, then you are going to pay tax only in the year of the completion certificate having been obtained by you. And the fair market value of the asset, on the date of such completion, along with the cash component of consideration, shall be the full value of consideration received by the landlord to be liable to pay tax. We made a statement therefore, individual HF only covered, other assets is not covered. Law talks about land or building or both, doesn't talk about anything else. Talks about a transfer of a land or a building or both. What if the transfer is not dealt with by 45(5)(a)? They're not saying what shall be the time of transfer. They're not saying that. They're only saying what shall be